Ladies and gentlemen, good day and welcome to Birlasoft Limited Q3 FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikas Jadhav. Thank you, and over to you, sir.
Hey, thanks, Faizan. Thanks everybody for joining us. This is Vikas from Investor Relations, and we have with us today on this call Mr. Dharmendra Kapoor, DK as we call him, our CEO and MD, Mr. Chandrasekhar Tyagarajan, Chandru, our CFO, Mr. Roop Singh, our Chief Business Officer, Mr. Sri Rangnath Kulkarni, SK as we call him, our Chief Delivery Officer, and Mr. Arun Rao, our Chief People Officer. So we'll begin the call with opening remarks from DK, followed by Chandru, and then move on to the Q&A session. Please note that anything that we say on this call and refers to the company's outlook for the future is a forward-looking statement and must be read in conjunction with the disclaimer mentioned in our Q3 FY22 investor update, which we have uploaded on our website and is also submitted to the exchanges. Now I hand over the call to DK. Over to you, DK.
Thank you, Vikas. Good evening and welcome to all of you to Birlasoft's third quarter financial year 2022 earnings call. Thank you for joining us on this call. I wish you and your loved ones a very happy, healthy and safe new year. We are pleased to report yet another quarter of strong revenue growth with improved margins. Quarter 3 revenue was at $143.4 million, registering a sequential growth of 4.7% and a year-on-year growth of 20.1%. Sequential growth in constant currency term was 5%, and year-on-year constant currency growth was 20.6% for Quarter 3. Quarter 3 total contracted value deal wins of $181.5 million were also healthy, with the new business wins contributing $121 million. The Quarter 3 YTD deal wins stood at $474 million, and the new deal wins were $319 million. As you can see, there is a clear difference that the ratio of EN and NN, which is the new deals, has improved considerably. That would mean that the upcoming growth would be far more predictable in future. Net new wins contributed about 18% in the 9-month deal wins, compared to around 3% in the previous financial year. In Quarter 2 earnings call, we mentioned about good increase in the enterprise solution deals across upgrades, new implementations, and transformational deals. While we saw some growth green shoots in the enterprise business in Quarter 2, this quarter it led the growth in the service line and delivered strong growth of 6.1% quarter on quarter and 8.1% on year-on-year basis. The other two service lines also posted good growth, with business and technology transformation services growing 4.4% quarter on quarter and 31% year on year, while cloud and base services growing 2.7% quarter on quarter and 29.2% year on year. In verticals, the growth was led by manufacturing, which was up 9% quarter on quarter and 20.4% year on year. At the back of stable oil prices and few large deal wins in the previous quarter, energy and utilities vertical also posted strong growth of 8.4% quarter on quarter and 20.2% year on year. The good news is that growth continues to be driven by large accounts, with top 10 and top 20 customers revenue growing at 5.4% and 4.6% quarter on quarter and 21.4% and 22.9% on year-on-year basis, respectively. This not only continued to improve our relationship with key clients, but also ensures better growth prospects. With the growth traction coming from the net new customers, the growth from X top 20 customers was also up 4.9% quarter-on-quarter and 15.9% year-on-year. Our customer count of $5 million revenue improved by one this quarter. In quarter three, the offshore revenue contribution of 49.5% is also at an all-time high. EBITDA margin improved marginally and stood at 15.2%, which is despite high attrition, one additional month of wage hike impact, and lower number of bill days and the furloughs impact in the quarter. And this, as you know, is the very seasonal quarter three phenomena for IT industry. We have been able to maintain 15% plus EBITDA margin against unprecedented supply chain challenges witnessed in financial year 22 till now. This is reflected in our LTM attrition number, which is at all-time high at 31.4%. The good part is we have seen some stability while we expect it to remain elevated for another quarter before cooling off from the beginning of the next fiscal. PAT stood at 15.1 million versus 14 million in the quarter two, and it was up 9.1% quarter-on-quarter and 16.6% year-on-year. INR PAT was at rupees 114 crore, up 10.5% quarter-on-quarter and 18.2% year-on-year. The manpower headcount at end of quarter three stood at 11,945 and saw a decline of 120 professionals quarter-on-quarter and the addition of 1,546 professionals on a year-on-year basis. Our headcount optically seems to have declined as it is reported on a quarter end basis. However, on an average basis, the billable headcount saw an increase during the quarter three. We worked well on optimizing our bench utilization during the quarter. We have started off campus hiring program and further 80 additional freshers have joined in January month itself. Coming quarter will see higher fresher intake and instituting skills to scale initiative in meeting the upcoming demand as well as optimizing resource costs. Birlasoft continues to get various recognitions. It was named a top 15 sourcing standout by ISG and among the leading providers in the booming 15 category globally, as well as for the Americas region based on annual contracted value won over the last 12 months. This is the 7th consecutive time that Birlasoft has been featured across named categories by ISG. Birlasoft was also named a leader in the SAP S4HANA system transformation mid-market in the US region by Information Services Group. Birlasoft's Project Shodham, a CSR initiative to stop crop residual burning, bagged a special jury award in the 7th edition of CSR Impact Award 2021. In conclusion, I would like to add that the demand environment continues to remain robust. Although there is a lower number of large deals in the market, however, opportunities are multifold in nature of smaller deals, which augurs well for Birlasoft. Demand surge continues in digital and re-initiation of transformational programs, with customers looking at shorter and sharper returns and focusing on cost containment while improving their spend on value-driven initiatives. The deal pipeline stands at $1.2 billion, and this is despite the deal sizes becoming smaller than before, and traction from both new and existing customers is better today. We continue to remain optimistic and are well positioned on capitalizing the growth opportunities. With this, I would like to hand over the call to Chandru for providing more colors on our financials. Over to you, Chandru.
Thank you, DK. Good evening, good day, everyone. Let me take you to the financial highlights for the third quarter in a little more detail. DK spoke about our Q3 revenue, which is at $143.4 million versus $136.9 million in the second quarter. This is up 4.7% quarter-on-quarter and 20.1% year-on-year. We did have a cross-currency headwind of 31 points, and therefore in constant currency terms, the growth was at 5% quarter-on-quarter. In rupee terms, we saw a quarter-on-quarter growth of 6% and a year-on-year growth of 21.7%, and the revenue closed at 1,072 crores. The EBITDA for Q3 was at $21.8 million versus $20.5 million in the previous quarter, up 6% quarter-on-quarter, 11.2% year-on-year. In rupee terms, EBITDA was at 162.8 crores versus rupees 151.8 crores in Q2, and that translates to a growth of 7.2% quarter-on-quarter and 12.7% year-on-year. EBITDA margin went up marginally quarter-on-quarter by 18 basis points, up to 15.2%, but it was down by 122 basis points year-on-year for the reasons DK spoke about. Margins were aided by volume growth, and also there was a one-time contract-related spend in Q2 that did not recur in Q3, and that helped us as well. That was, of course, a small component of the improvement. There was some impact on the one additional month of wage impact, as we spoke about. We also had an increase in our subcontractor expenses given the current surge in demand versus supply. Our PAT for Q3 was at $15.2 million versus $14 million in Q2. That was up 9.1% quarter-on-quarter and 16.6% year-on-year. In rupee terms, the PAT was at 114 crores, up 10.5% quarter-on-quarter and 18.2% year-on-year. Our DSO was at 55 days. We improved 2 days year-on-year. Of course, there was a slight dip of 1 day quarter-on-quarter. However, we believe that this is a very optimized performance. Cash and cash equivalents stood at $152.6 million, rupees 1,135 crores as of 31st of December, versus $144.6 million, that is rupees 1,074 crores as of 30th September 2021. Our cash was up $16.6 million or rupees 124 crores on a year-on-year basis. CapEx for the quarter was $5.3 million, which is 39 crores. This included the renewal of a lease agreement of one of our office premises, which led to an increase in our right to use assets by about 23.5 crores. The rest of the CapEx was related to IT and related assets. Our operating cash flow was at $16.4 million or rupees 121.6 crores and stood at 74.7% of EBITDA. Our free cash flow was at $11 million or 82 crore rupees, and that's 71.8% of our net income. We continue to see improvement in our financial metrics, and we will continue to strive to better them on an ongoing basis. With that, let me throw the floor open for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Baidik Sarkar from Unifi Capital. Please go ahead.
DK, good evening and congrats on a good quarter and order intake. A couple of questions. In the context of how buoyant environment has been for the hyperscalers and our own relationship with a few of them, our performance in cloud and base seems a bit soft. Was there a one-off here, and how you see acceleration? And secondly, given how healthy our order intake has been, would you reckon we will break out in growth rate starting now, or would you advise caution in the absence of large deals per se, like you mentioned in your opening remarks, and the high contribution of package implementation, which could be a slippery base to defend?
So thanks, Derek. No, I think I would not bring any caution when it comes to the growth, because we definitely are seeing good momentum, good pipeline, good input of the queries and the pipeline coming from the client side. So we are seeing definitely good inflow from that perspective. So there is no reason for having any caution with respect to the growth, whether it is cloud and based services or it is any other service line. I think in all the aspects we are seeing good set of momentum. Having said that, what we have to continue to watch is that the biggest constraint today that is there in the industry is on the talent supply. Because growth is not an issue, it is the talent supply that is a challenge right now as to how quickly can you bring it up and capture the growth that you want to do. I think that is the only challenge I see. Other than that, whether it is our larger customers or whether it is smaller customers or even the deals which are, we know that these are large, but the contracted value is going to be smaller because those are broken into the modular approach. All that is there, and that definitely gives us very good confidence going forward that we have lot more predictability today for the growth in the upcoming quarters.
So on margins, DK and Chandru, the worst of supply chain issues might be behind us. And keeping that in perspective, would our march towards a 16.5 sustainable margin be possible in the first half of 23, or should we postpone that expectation as well?
So what I would expect is that we have started inching upward. We have addressed the fall that was happening in the margin. Okay. So that is a very positive sign. Now, how much we really jump, okay, it is going to be like every week, every month that we continue to discover that where all the optimization opportunities are there. But the attrition, which I thought that should start getting stable in this quarter, it is not yet. So I would say that we have to keep our fingers crossed while we definitely are moving upward now. But I would stay away from giving any commitment on what it would be in this quarter.
Sure. Best wishes, gentlemen. Thank you.
Thank you. The next question is from the line of Sandeep Agarwal from Edelweiss. Please go ahead.
Hey, hi, DK and team. Congrats on good execution. Happy New Year to all of you. Just one or two questions. First, DK, while you don't want to give any optimistic statement or something on the demand management, but if you see the way clients are spending, the type of spends they are doing, and what the spend accomplishes for them, how do you see these spends to be there for next 3-4 years? You think them to be robust, or it is hard for you to comment on next 2-3 years? That is number one. Number two, while attrition industry-wide, attrition going up is always a good sign because it is a lead indicator of good demand. But the way it is going up now, do you see signs of it retracing from here, or you still think that there is a chance of it not falling anytime soon?
Okay. No, thank you, Sandeep. Very relevant questions. So you said that I don't want to give the optimistic outlook. No, I am absolutely optimistic, first of all. Whether it is revenue or whether it is margin, I am absolutely optimistic because when will you ever be more optimistic than when the demand is very good? So I'm absolutely optimistic. However, we have the policy that we don't give the number, and that's the reason I'm staying away from that. But I'm absolutely optimistic. Having said that, I think the revenue spend, if we look at that, there is a marginal increase in the revenue spend that the clients are bringing up. Okay, so which is a positive news. But we also have to look at that how the revenue or how the spend is shifting. So what they are looking at is that how do they continue to become more productive, more efficient in the run business, whereas they put more and more money onto the transformational programs. So the buckets will change. Okay, that is one thing will happen. At the same time, there is definitely increase in the IT spend that a lot of customers are having. So which is a good news. Many of the other customers will actually start slowly opening up as we move forward. But I am seeing the positive signals in the market definitely. So that is one aspect of it. Now, when it comes to the attrition, yes, you are 100% right that it is a good news that that it is a indicator or leading indicator for higher momentum that we are seeing. So yes, attrition is high. Okay, we might complain about the attrition, but we are not complaining about the growth. So yes, that will be there. My view is that if you look at carefully, most companies are somewhere around 27 to 30, 31% of the attrition. Now, there is at least about 10, 12% of the people who are actually moving from one company to another company, rather than that is the real growth-related attrition. So I believe that whether it is in 1 or 2 months or in a quarter or 2 quarters, it is going to come down because people are not going to continue to move. Okay, so it is going to go and stabilize in the shorter or mid-term. So I believe that somewhere the attrition with the current level of demand should be in the range of about 18 to 19%. And I think that is where it will stabilize over a period of time. We are yet to see that it starts stabilizing. There were few days that we saw in the Q3 that it might be getting better, but then the Omicron came in, and then we are seeing people getting back to home again, and then there is this whole thing is continuing. Okay, so I believe that as things start getting normalized, okay, start becoming more and more stable, the attrition will also stabilize with probably another few months to go.
Okay, thanks, DK, for that answer. Thank you, and best of luck for current quarter.
Thank you.
Thank you. The next question is from the line of Shraddha from AMSEC. Please go ahead.
Yeah, hi. Congratulations to the management on a good quarter. DK, you did indicate that the deal pipeline number is close to 1.2 billion for us, $1.2 billion. But would it be possible for you to say how much is it up on a Q-on-Q or a YY basis?
No, this is the pipeline this is a sales pipeline. That what are the deals that we are working on? Okay, so I don't think that until we reach to the stage of the deal that we know how much it is going to be ACV or TCV. That will be yet to be seen. But a lot of deals are actually of a good number, a good size. That would mean that while it will increase a good ACV number, there will be some good amount of revenue that we will be able to win on the TCV perspective also.
So the sales pipeline of $1.2 billion that we are talking about in this quarter, what was that number last quarter? I mean, any indicative number?
It was about 100 million lesser in the previous quarter. If you look at the same quarter last year, it was approximately $700 or $800 million, if I remember right.
Okay, got it. And you also indicated that ERP deals are back in the market. So last year we had seen almost a flattish kind of a run rate in the ERP service line for us. So do you think going into FY23 we can expect a good bounce back in ERP, and if not higher than company average growth rate, it can still grow much faster than what it had done last year?
Absolutely. And we definitely are already seeing that happening with most of the enterprise solution deals.
Right. And lastly, on the life sciences vertical, we've seen some moderation in growth rate in this vertical for some time now. I expect some of it.
Sorry, go ahead.
Yeah, some of it could be because of normalization of numbers in InvaCare. But apart from that, is there anything that is happening in life sciences? Because on a YOY number also we have come down to almost a 10% growth only in this vertical, which was one of the fastest growing verticals for us 2 years back.
Yeah, you are absolutely right. Your guess is absolutely right that it is because of the normalization of numbers in the InvaCare, because we have done a big release in the previous quarter. Okay, that was the first month of that. So for the quarter, we did not get the revenue for the transformation program. We are already defining the next set of scope for them. Okay, and we hopefully will begin again on that side in some time in the month of February. And that would mean that some part of that revenue will start coming back. So yes, it is about the transformation program reaching to a particular milestone, and now there is a break in terms of defining the next set of scope.
Right. And because I think I missed the number. You gave out the number of net new deal TCV contribution. What was that for this quarter?
For this quarter, it was about 7% plus.
Okay.
The net new.
Net new. But it has come off from last quarter. I think it's like, if I recall it right, last quarter was a higher net new contribution number.
If I look at the last quarter, we had total wins of about 121 or 123 million. And this quarter, we are talking about 182 million. And 121 million are the new deals itself. So this quarter is far better. We are talking about the percentage because percentage is deceptive generally, but the absolute number is higher in this quarter for the net new wins.
Sure, got it. Thanks so much.
Thank you. The next question is from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Yeah, hi. Thanks for taking my question. First of all, congratulations on good set of numbers, a good growth there. My question was on the pricing front. I mean, how are you seeing pricing? I mean, what kind of pricing are clients ready to give in this current environment, given there is attrition and demand environment is also good?
Yeah, no, I think there is a reset of pricing definitely happening, albeit low or slower than one would like to have, but as I said in the previous quarter also that we have started discussion with many of our clients to revise the price, and quite a few of them had changed that in the quarter 3 itself. Then there are some who are changing it from the 1st January. So there are different dates based on the SOW and the contract date. Okay, these prices are getting revised. It is a slow process because clients would like to delay as much as possible, and we would like to do it as soon as possible. So there is a negotiation that goes on, but the prices are getting reset definitely, and clients are far more willing to have the discussion now.
Understood. Yeah, sure. If you can give a number and indicative range as to what kind of pricing adjustments are the client ready to give?
So there are a couple of elements that are there. Okay, there is a COLA element that is there, or there is a revised pricing for the new demand that is there. So both the things are happening. Many of the clients who said that they will negotiate COLA at every year, and eventually they will say that no, we cannot take it up. Okay, now they all are giving us actually the COLA. Wherever we were not able to get it, I think the COLA is back for this year. That is one thing, or anything around 3% to 4% that is happening. And then for the new demand that is there, it is easier to negotiate the higher price because you don't have to go and fight for the existing business. You have to only fight for the new business. And that also has started happening. And anything from 5 to 10%, depending upon what kind of role, what kind of profile, what kind of skill it is, you can go and attract 5 to 10% additional charges on those skills actually.
Understood. Yeah, sure. And just one more question. So, I mean, you mentioned about the good demand environment being there. How should we see this demand environment, and would the current growth rates be there for the next 2 years? I mean, any color on that would be really helpful. I mean, we understand that demand environment is good, but I mean, how is the sustainability of this growth rate? That would be good to understand.
Yeah. See, it is also going to follow the pattern that it has followed always. That means that there are early adopters who have jumped the bandwagon and said that we need to transform, we need to digitalize, we need to move to the cloud, we need to have better. So all that has started happening already, and these are mostly the early adopters. And the people who are ready to pay a little bit of premium in order to get the access to the talent. So that has started happening. But then there will be others who will be the followers, followed by those who are laggards actually. So in my opinion, for about 2 to 3 years minimum, that potential is there for the growth and for the momentum.
Okay, for the current growth rates to sustain, there is still 2 to 3 years of headroom.
Absolutely.
Understood. Yeah, sure. And just one more question, if I can squeeze in. I mean, how many freshers are you looking to add in next quarter and in 23?
So this year, by going by the way we have planned, we want anything around 1,500 freshers coming up and joining us.
Yeah, and next year?
Yeah, I'm talking about the next year. This year, I think we should be able to go up to about 900 or so. We planned it for a little higher number in the mid-year, but then there are dropouts also because of the whole demand suddenly picking it up. Okay, but the next financial year, we are going to add because we have given the offers in many colleges. So we expect that about 1,500 the freshers will join.
Mr. Manohar, does that answer your question? Mr. Manohar, does that answer your question?
Looks like I think maybe he has dropped.
As there is no response from the current participant, we'll move on to the next question from the line of Mohit Jain from Anand Rathi. Please go ahead.
Sir, I missed your opening remark a bit. So you said there was this headcount decline. What was the reason for headcount decline during the quarter?
No, it is only the quarter end count that we have given because we have given it at the end of the quarter account. But overall, if you look at the build resources and build hours was far higher, and that's the reason that we are showing the growth also. So, but it is only that at the quarter end the number is that, and there are reasons. One that I talked about, our transformation program got finished, so we moved the resources whereas the growth came, but not as many resources. We also optimized on our bench side. Okay. At the same time, there are few things that we have moved from time and material to fixed price, and that is also where we have optimized. So there are multiple small factors in the line of improving our margins. We have gone and looked at how do we improve our productivity and efficiency, and that is the reason that at this time we are at this level of headcount.
So, okay, so assuming people left towards the end of the quarter, that is what you mean to say? Or
yeah, correct. Either left, okay, but we have kind of replaced the, what you call, for example, in time and material to fixed price, we have reduced the size without reducing the billing, okay, in some of the cases. So that has happened. At the same time, there is a bench efficiency that we have improved, okay. So that is the other aspect of it, and that is how it is at the end of the quarter.
So what is the plan like for next quarter? Are you giving any hiring numbers or?
I am not giving hiring numbers, but if we had to grow with the same pace, then we will have to have net addition from the point where we were in the quarter 2, because whatever efficiency that we wanted to gain, that we gained here. Now, wherever we will improve the productivity, that much will be there, but there will be a net gain and net hiring that will happen.
Okay, and the second was anything on wage hikes for this calendar, given that our attrition is also above the industry in some sense, and you want to hire more. So from that perspective, should we assume that it will be as stressful as this year?
Oh yeah, absolutely. Yeah. The wage is, of course, a universal issue now that that we have to continue to watch out, but we have to continue to attract the talent by ensuring that we are giving them the compensation that is in line with the industry norm right now. It is a new norm that has been set, but we have to remain competitive in that front also. So yes, that will happen.
So which quarter is it planned for? Like Q1, or should we assume that it will happen throughout the year?
I'm sorry, what was the question again? Say it again.
The hike is planned for Q1, or should we assume it will happen across quarters, like based on correction?
No. It doesn't happen across quarters. One has to continue to balance, but we have to have the model that will really look at that what is that you're giving when you are hiring lateral, what is that you have to give it to your existing people, so that you continue to keep the balance. Okay, that is the model on which we work. And if we look at that, there will be some impact that will come in every quarter, but it has to match with the expectation that we had to set for ourselves on the margin front. So both have to go hand in hand, okay, rather than there is an abrupt jump in the compensation in one quarter and then abrupt jump in the margin in the other one. It doesn't happen that way. So we have to take both hand in hand. And in some cases, we commit today, but we stagger the benefit to the employees, okay, and the commitment. So all that we do so that we are able to gain the retention by giving the incentives to employees. That increases their compensation, but it doesn't have an immediate impact at that point of time.
Okay, so two on the sales side, like one is on manufacturing. What kind of growth rates are you expecting? What happened during the quarter? And second was there is this stagnation in 1 million plus accounts, which is there for a few quarters. So how do you plan to sort of correct that, or does it reflect new client addition is little on the softer side versus?
$1 million account, I think we increased by 1 this quarter, if I remember right. Okay, so that is right. Yeah, now we have 27. Okay, so I don't see that as a concern. Top 5 we have also improved it by 1. Okay, the $5 million account also we have increased by 1. So I don't see that as a concern, because $1 million accounts are the accounts also where there are a lot of transformational programs that are happening. And many a times these are the accounts where SOWs are signed in the series, okay, and not in the form of a TCV value. So at any point of time, we may not show that account is giving us a TCV of a very larger amount. So I believe that it is not too much of concern for us. But yes, we would continue to look and hunt for the larger deals so that we continue to gain the presence in the top 30 accounts or top 38 accounts.
Okay, and sir, last on the manufacturing.
I'm sorry, I missed the question on the manufacturing.
The manufacturing vertical growth for the quarter, and what is the outlook going ahead?
I believe we grew manufacturing almost by 9% in this quarter.
Right.
Chandru, do we have that number in front of us?
Yes, DK.
You're right. What I meant was, what is the nature of this growth, and are there some projects which will end, or we do get some demand ahead of the time, or should we expect strong growth to continue in manufacturing sector?
No. I think we should expect that growth will continue to go on. There's a lot of work that we are doing in the high-tech space, in the digital space, where there are significant amount of opportunities are coming on the platform side. I have spoken about our strategy moving forward going to be business-ready platform, okay, where we are going to bring about the benefit in the tech space in every single industry. And manufacturing, definitely we have seen good benefit because we have some good present service offerings that are digital in nature on the business platforms. And I think that is giving us the good growth.
Okay, that's all from my side, sir. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Thanks for the opportunity and congrats on a good execution. DK, when I look into your lead indicators, the 9 months new business TCV has been gone up by 20%. You are saying enterprise solution likely to do better in the next coming year versus what we have seen in the last 4 quarters. Also, the deal pipeline on a YOY basis is up by 30 to 40%. So is it fair to say entering FY23 or calendar year 2022, you are much more confident versus entering CY21 or FY22? And growth rate has a more upward bias in terms of a growth in FY23 versus FY22?
The simple answer is yes. And it is very much clearly visible from many of the parameters that you talked about, that it is giving the indication that the next financial year is going to be better.
Okay, that is helpful. And just on the fourth quarter margin, because most of the wage hikes is largely done, you are also confident in terms of the pricing as well. You are also doing better in terms of a productivity gain. So why are we shying away to at least give a flattish kind of a margin outlook in fourth quarter versus third quarter as a whole? And do you believe margin management could be better in FY23 with attrition challenges maybe slowing down and the pricing could have a full year benefit versus may have a part benefit in FY22?
Yeah, so the only reason that I don't commit, actually there are 2 reasons. One is that we don't give the guidance, as per our policy. So that is the one reason, but I have indicated that I think we have addressed the fall in the margins, okay, and we want to continue to improve from here. So that is one thing. Second is that we are also looking to invest because if you clearly look at I talked about our strategy, our image was that we are an ERP company. We have moved from there in the last 3 years and have become an enterprise, a digital company. Very good revenue, very good balance in the digital as well as in the enterprise solutions. Okay, and ERP also now from ERP have grown to enterprise solutions and we have brought in multiple solutions into the portfolio. So from that perspective, I think we are far more confident from that perspective. But going forward, I believe that the reason there is a significant momentum in the market is that there is a spend in the tech sector, whether it is in manufacturing, whether it is high tech, whether it is banking and financial services like InsurTech or FinTech, or it is the medical devices like MedTech. So there is a technology sector coming up in every single industry. Now, how do we cater to that? How do we serve that? There are different set of offerings that will be required for them. And we need to be prepared for that. And our going forward strategy will be that we want to be a business-ready platform company. Now, to do that, we need to invest also. Okay? So that means that while we continue to improve the efficiency and we continue to deliver the margin that we are committing that we will deliver, we also have to look at how do we save some so that we continue to invest also. Because we don't want to squeeze every single penny and say that no, we will not invest, because then that would mean that our story will be finished in next 2 years or 3 years. So if we have to become a billion-dollar company faster and become even bigger company, that means that we will have to also continue to invest in the newer offerings, because more and more revenue will start coming from the newer offerings and newer set of the client in every single industry.
Okay. So can you throw some light in terms of your comfort range on EBITDA margin for the next medium to longer term?
I have always committed that I want to deliver more than 15%. And I have delivered even up to 16.9%. But even then, at that point of time, I said that my commitment will remain that I remain upward of 15%.
Okay. And just last short-term question. There are no furloughs in the fourth quarter versus third quarter as a whole, plus new business TCV on a Q-on-Q basis also looks good. Is it fair to say we have a chance to do better growth momentum in 4Q versus 3Q?
Yes, it looks like, but let me tell that the number of days are not much higher than the quarter three. And I'm sure that every IT service provider would have said the same thing, because there are going to be weekends and leaves and holidays even in this quarter as well. Okay, that is there. But still, I don't think that furlough will be there, because furloughs, whatever happens, generally happens in the month of December. We were able to address to a good extent, but of course, some furlough still happened. And that is the benefit in this quarter that we will definitely get.
Okay. And last question, if I can squeeze, just on enterprise solution, the kind of nature of demand which you're witnessing, you believe is it a short-lived or may have a life for medium to longer term, where people are converting from or upgrading from on-premise to the cloud version, where demand could last even more than 2 years, 3 years as a whole?
So I tell you, the value is coming now at a next level of ERP. The value that was required at the business process level, people have got it. Okay, it is only at the next level where there is an intercompany exchange of the data and the intelligence. That is where the next value of ERPs or enterprise solutions is coming. So you will see that all the ERPs are going to grow in that direction. And that is what we have been calling for last 3 years about enterprise or digital, that how the digital will sit on top of the ERP and how even the ERP providers will become equally digital. And that is what is happening, and that is the reason that this is not a short-term phenomena. This is going to be a long-term phenomena, because it is not about migration to the cloud. But what do we do when we move to the cloud? What benefit do we get? What extra value that I get by moving to the cloud? That is what the clients are looking for. And that's the reason I believe that our enterprise digital story sells very well on those places.
Okay. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Abhishek Shandatkar from InCred Capital. Please go ahead.
Hi. Thanks for the opportunity and congrats on a good quarter. My question is again on the ERP side. If you can just give us a color in terms of the order book that we are gaining. What's the mix on SAP, Oracle, JD side? What are the kind of deals that we are signing? That could be helpful. Related question to that is, what's the fungibility of our existing employees? If we are seeing a higher attrition in the employee base which is catering to the ERP demand, would that entail hiring of laterals, and will that have an impact on margins? And in case if we can go ahead and deploy freshers on those projects, is there any difference in terms of training number of months for those freshers for those ERP programs? Thank you for taking my questions.
Yeah. No, I think on the ERP side, we are seeing growth in all the ERPs. In the SAP side or in the Oracle side, okay, we are seeing growth in all the places. In fact, we are also looking at that the other enterprise solutions such as Salesforce or ServiceNow or many other niche solutions, the growth is there also, and it has started to pick up very well. So that's a very good news that is there. Now coming to the attrition, yes, wherever you will see more specialized roles, the attrition has picked up. But we do have the pipeline to grow and upscale our people also, and that is how we are managing that. In many of the cases, yes, we had to hire the lateral, and we have to really look at how do we go and have the discussion with the client to attract the better prices also, because it is not only that we have this issue, even our clients are facing the same issues because, as I earlier said, that the fight is about talent access and not about the rates. And when it is about the transformation programs, the level of value that gets delivered is far higher than the price or the additional price that the clients pay. So we are seeing that, yes, we have to hire lateral people also. At the same time, we are hiring junior people and upskilling them also. So cost definitely is increasing. But in many of the cases, we are able to attract better prices also.
Okay, that's helpful. And in just the last question, in terms of deploying pressures, on those projects, is there any difference in terms of training programs or the number of months?
Yeah. So the skill to scale program that we have, that is precisely for that reason, because we have started looking at various level of people that we hire either from the colleges or we hire laterally junior people who can be upskilled in order to play the larger role. Okay, so both the things that we are doing, and there are training programs both online as well as offline that are being provided in order for them to get upskilled very, very quickly so that they can be deployed on the programs and the projects. So both the things are happening. In fact, what we are also looking at is the rotation, because when you are increasing the compensation for people to retain them, you also go and negotiate with the client that how will you rotate those people out to the other engagements so that you can tag them with the other people who are coming from the skill to scale program, and jointly they can build the team to deliver the engagement that is required. So there are 3 or 4 different strategies that we follow on that.
That's helpful. And just one last data point, attrition. Can you just help us understand what has been the quarterly annualized number, both for last quarter or at least for, how it is trending over the quarters, because that could help us understand, your comments on attrition. Thank you for taking my questions.
Yeah, thank you. The attrition cost was about 31% or so. FK, you have exact number in front of you, if you can give that?
Yes, DK, that 31 is the right number that you mentioned. Yeah.
Okay. 31% is the number that is there.
Sorry, is that the quarterly annualized attrition?
This is for the quarter 3, yes. 31.4% is for the quarter 3.
Okay, but that mentions in the investor release is mentioned as the LTM, right?
Yeah, so quarterly annualized is 34%.
Okay, perfect. And what was it the previous quarter?
Because do you have that data with you?
It was about 30%.
Okay.
Okay, sir. Thank you for taking my question and best wishes for.
Thank you.
Thank you. The next question is from the line of Nilesh Chethani from BOI AXA Mutual Fund. Please go ahead.
Hi, sir. Thanks for the opportunity and congrats on a great set of numbers. So my first question was on the margin walk or margin bridge. So QOQ, we have seen improvement in the margin despite attrition, etc., going up. So I wanted to understand if one wants to break up this growth. So what was benefits coming from operating leverage? What impact was due to wage hikes? What impact was due to currency depreciation? So any bridge would be really helpful.
I do have the bridge, okay, but it will be a more detailed answer. Let me just fetch that, okay, and provide that.
Let me take that question in detail, okay?
Yeah, sure. Go ahead, Chandru.
Chandru here, Nilesh. So in terms of the margin improvement, they came from primarily volume growth and improved operating levers, and DK spoke about the work we've done optimizing our bench and optimizing utilization and resources during the quarter. So those were roughly we got about 90 BPS on account of volume growth. We also got some improvement on account of the fact that on a quarter-on-quarter basis, like I said, there was some one-time contract-related spend that was about 50 basis points. Impact standpoint, there was, like I said, one additional month of wage impact. There was a negative about 70 basis points, and there was also an increase in our subcontracting expenses, quarter on quarter. That gave us a negative of about 50 basis points. So roughly, this was the bridge, Nilesh.
Got it. Really helpful. And second question was on the growth outlook. So historically, just to give our outlook as far as T20, T21 clients are concerned, the growth outlook on them. So I wanted to understand where we stand today as far as growth outlook for the top 20 customers is.
So if you look at even today, we are growing more than 20% for the top customers. So I think that definitely remains very, very robust for us. And that is because we have a very clear initiative and focus on growing with our top 38 accounts. And that's the reason you will continue to see that we will bring more and more and better growth in the top accounts.
Okay, sir. Got it. Thank you so much. That was really helpful. Thank you so much for replying to our questions.
Thank you. The next question is from the line of Vaibhav Badjatya from HNI Investment. Please go ahead.
Hi, sir. Thanks for providing the opportunity. Just wanted to understand on the sales front, do you think over the course of next 6 to 1 year, do you think there will be a substantial change required in terms of our sales effort, or do we have to substantially change the incentive of the sales people or hire aggressively on the sales front, or you are currently satisfied with the pace we are going currently on the sales side?
So I don't think that efforts are going to change as much, but our strategy continues to evolve. And I have spoken before also, how we moved from project-based company and moved to become an annuity focused company, and we had to change the incentive keeping that in mind. Similarly, we said that rather than just being a project-based, how do we do cross-selling, okay? Because we wanted to become verticalized completely, and that we changed the incentive structure, okay? So that we looked at. And then we looked at that how do we go OEM-based net new selling as a separate, initiative. And we did that in the 9 months as an experiment to create a hunting engine in the organization. That got successful, and we had kept separate focus on that front also, and that gave us the benefit and the incentive to the people that we kept it that way. Going forward, we are going to have a shared, or you can say dedicated hunting engine, okay? And that will be on the commission base, whereas there will be an account management deeper focus so that we continue to cross-sell based on the benefit that we saw in the last 2 years. So we continue to grow our larger accounts also by having a very stronger focus on the client relationships. So there will be a 2 set of incentives that will come up. So our incentives have changed in the last 3 years every year.
Mm-hmm.
And we have evolved to current stage. So yes, we absolutely have continued changing, and this year also we will change. I don't know for the next year. We will continue to watch out because change is good, and that change is the only thing constant, and we have to continue to bring the new changes in order for us to remain very effective. So we will do that. But I believe that when we are going to put hunting engine separate from the farming or from the account management, I believe that we are creating a path for becoming more focused on the platforms, okay? Because then I will have to focus on lesser number of salespeople to train them on newer set of services and not to the entire set of the sales. Okay, not that everybody is not supposed to learn, they will, because we will cross sell also. But when you're going fresh in the market with the new offering, your hunting engine is the one who takes the lead. And that would mean that in the beginning, we will have to really bring them up to the same level. And that is what we will do. But I believe that 6 months down the line or 1 year down the line in the next financial year, probably we will have to look at when we are ready for taking it to the farming engine also, and whether we need to make it incentives based on the offerings as well. So we will continue to evolve, continue to change as far as the incentive schemes are concerned, because market is changing very, very fast, and we definitely want to continue to change the behavior in which way we go and sell it to our clients.
Right. Just a small observation or a request. In your KPIs that you disclose, so you have this headcount disclosed in terms of sales and support. So if you can bifurcate that between within sales and support, what is sales and what is support, that would be really helpful, because support is also generally a very large number. So that we can see that how the sales efforts are going specifically.
Yeah.
I think that's it from my side. I think I'm done with my questions.
Arun, will you be able to answer the data with that? Give you a live loss of session numbers. Yeah.
Sorry.
We have said that the sales and support today is 1104. Okay, in comparison to 1120 in the quarter 2. So what is the shift? Because as far as I know, the sales we have grown a little bit, whereas support we have reduced. That's the assumption that I have. But if you have the breakup, if you can give that.
Yeah, so I was not just talking about one quarter. I just wanted to see the progression for last 2-3 years, and from that perspective, I just made the suggestion that if KPI can be disclosure and KPI can be bifurcated between sales and support separately, that would be helpful.
We can definitely do that, but in the meanwhile, maybe I can definitely get you the answer on the sales side. Roop, you are there. Maybe you will know how people in the sales team has increased during the year, from previous year to this year and then quarter on quarter. Just to give the color to that,
Yeah, that would be helpful,
I mean, our sales headcount this year is up by between 8 to 12% based on, from like to like last year.
Okay. Yeah, okay, that's it from us.
Thank you. The next question is from the line of Devanshi M. from BNK Securities. Please go ahead.
Hi, sir. This is Devashish from BNK. Thank you very much for taking the question. Good to see that ERP started coming back for us. I have first question related to ERP only. So the growth that we are seeing 6% sequentially and 8% YOY, can we bifurcate this? How much of this growth is coming from our traditional clients like Oracle, JD, and how much growth is coming from the new agreements that we have done with new hyperscalers? If we can bifurcate, even qualitative guidance will also be fine.
So Devashi, we have actually stopped tracking the bifurcation on the ERP basis, for simple reason that there is so much of revenue that happens with the shared service between all the ERPs. We have changed the model a little bit where there are shared services also between the ERP. For example, doing the testing, or for example, doing the master data management. Now we have stopped tracking because it creates more and more confusion. And that is the reason that we said that we will look at the enterprise solutions altogether rather than try to look at every single piece. So I don't have the numbers as of now with me, but if you would like to know, maybe Vikas can provide you those numbers sometime later.
Sure. And the second question is related to the attrition numbers that we are seeing. So we are currently, I think, one of the highest among peers. Whether we compare with larger peers or we compare with smaller peers. So do you think that some policy level problems that has happened with us, which has kind of pushed our attrition higher among all, or it is like that a general sense that you are getting that the demand is so high that attrition for everybody is high and it is expected to come down for us? And a related question is, do we have any growth sacrifice for the number of, for the supply constraint that we are seeing in this quarter?
No, there is no policy-related aspects that will contribute to the attrition or something like that. It is just that I know sometimes a couple of percentages will be up and down for all the peers because, for example, last quarter there were others who were showing higher attrition than us. So that was there, and most of the peers are in the 25, 27 range. Okay, and sometimes also it is about the way the numbers get reported. Okay, so that also I don't know whether it is consistent across the companies or not. So that is also, I heard, issues are there. But I think concern is there in every single company beyond the level of comfort. Okay, so we have to look at how do we continue to change our policies, how do we continue to evolve our model so that we bring the attrition in control. 1%, 2% here and there, in my opinion, is less of a concern in the shorter term.
Okay, and about the growth sacrifice because of the supply constraint in this quarter?
So, no, I think that we have been able to grow well, okay, and that means that we have been able to attract the talent. That remains definitely very, very positive, and I believe that that is not changing much, and we are, in fact, only broadening our way to attract the talent further. So, constraint definitely is there. Okay, I would not say that the constraint is not there. But are we able to attract the talent? Yes, we are able to attract the talent. Will there be pressure on the cost? Yes, that will be there. But I also believe that soon, things should start getting normal because the 8 or 10%, that is the rotation between the companies. Okay, at any point of time, people are roaming between the companies. And when that gets stabilized, most of the companies will come back to the level of about 17-18% of the attrition, which we have seen it multiple times in our career, and we know how to handle that very well.
Excellent, sir. Thank you very much for answering my question.
Thank you.
Thank you. The next question is from the line of Dipesh Mehta from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. First, on the data part, can you say the number of freshers we added in 9 months?
Sorry, can you please ask the question again? Your voice dropped for me.
The number of freshers we added in 9 months?
Approximately 900 that we would have added, okay, in the last 9 to 12 months, if I remember right. Okay, and going forward, our plan is that the next year we are planning to add 1,500.
If I remember our number correctly, in first 6 months we added only 430. So do you mean we added around 500 in Q3?
No. In the quarter 3, we would have added approximately, if I remember, around maybe 200 or so. Arun, do we have the number for the quarter 3, the freshers?
Quarter 3 will be close to about 300 odd, DK.
Okay. Yeah. So that's what I said, that last 3 to 4 quarters.
When you mentioned the numbers, you spoke about 9 to 12 months.
Can you speak a bit louder?
Arun, you were saying something. Can you repeat that?
No, I said, can you hear me now?
Yeah.
I was saying that in Q3 we would have added close to 300. But I was just pointing to the fact that when you spoke of 900, you were talking about time range between 9 to 12 months, the last 9 to 12 months.
Yeah.
Understand. The second question which I have about annuity revenue mix, can you say what number now we will be?
Last quarter, we were at 72%. We have not computed it this quarter. We will compute it again in the quarter 4, but we were at about 72% in the last quarter.
Understand. And last question is about considering the overall attrition and very strong demand, are we seeing any revenue which we are leaving on table kind of thing because of such a high attrition? And any slowdown you are witnessing, let's say in terms of our new client, because new client is also one of the good growth engine for us. Because of Omicron and surge in COVID cases, any slowdown in new client related interaction?
No, we are not seeing any slowdown, but there is definitely some revenue that now we leave it on the table where the margins are lower and it is not strategic customer for us. So earlier we may be far more open to add a tail account, but now we have become far more careful because when the resources are limited, then you want to serve first to your strategic and important customer rather than trying to add non-strategic tail end customers.
If that, so because if I look your 1 million plus account, which we used to have, let's say 85, 86 pre-COVID era. Now that number is around 77, which is almost 10 odd kind of decline. Do you think considering focus on strategic account, relatively large account, this number should inch up faster in next few quarters?
No, I expect that this number will go up.
Understand. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Dharmendra Kapoor for closing comments. Thank you, and over to you, sir.
Yeah. Thank you very much, everyone, for joining the call and asking very pertinent and direct questions to understand what our near-term and long-term strategy is, but also understanding that how the momentum is really giving us the confidence. At the same time, also understanding that what all levers we are pulling in order for us to continue to provide predictable growth as well as the margins that are above 15%. So that is what will remain our focus going forward also. We remain committed to our billion-dollar dream. It is not changing. By 2025, we want to be a billion-dollar company. And I believe that as every quarter passes, our confidence in achieving that continues to increase. And with all your wishes, I'm sure that we will be able to achieve that in time. So thank you very much once again. Please stay safe and continue to remain in touch. Thank you.
Thank you. Ladies and gentlemen, on behalf of Birlasoft Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.